been a lot of movement in the markets over the last 3 months, certainly, but it's been largely in a tight trading range, with the exception of that big sell-off at the beginning of February, as you can see from this chart. Stocks look like they're trading in a pretty tight range, with the exception of that move. One of my next guests says it could be the sign of things to come for the next decade. Joining me now, Larry Cantor, head of research with Barclays Capital, along with Vitaliy Katsenelson, adjunct professor of equity analysis at the University of Colorado at Denver, author of Active Value Investing, Making Money in Range-Bound Markets. Gentlemen, good to have you on the program. Welcome.
Thanks. Good to be here.
So let's talk about the ranges of this market. Vitaliy, I'd like to kick this off with you. You're expecting that we're going to see short and trading moves for this market over a decade?
Yes. When I was doing research for my book, I looked at the markets over the last 100 years, and what I found that every time we had a secular bull market, a market that went up for a long period of time, the market that followed was not a bear market, as most people think, but it was a range-bound market, a sideways market where stocks went up and down for a long period of time. So the last range-bound market we had was from 1966 to 1982. So the last decade, from the last 10 years, we suffered through the range-bound market, and I believe we're going to be in a range-bound market for another 10 years.
Larry, do you agree with that? And how do you make money, if so, if we're looking at a range-bound market?
Well, 10 years is a little beyond my forecast range. A lot of stuff can happen in 10 years. I think, at least over the next couple of quarters, we're remaining pretty bullish because you right now have this combination of zero rates, so you're not getting paid to keep money in cash or, riskless assets. You've got economic recovery, and the one in the U.S. we think is just at its early stages, a lot more to go here. And you've got deleveraging, and the flip side of deleveraging is an increase in saving. In other words, the corporate and household sector are saving more and spending when that adds to financial assets. So for at least another quarter or two, we remain bullish. I think beyond then, medium term, probably it is a little less optimistic, given all the fiscal tightening and monetary tightening we're going to have eventually. But again, a lot of stuff can happen in 10 years.
Yeah, sure. Okay, so I want to ask you, how do you invest then in that environment? But Vitaliy, let me go back to you here, because you believe we are going to see a range-bound market for 10 years. How do you make money in such a market?
Well, number one, Maria, I think it's a lot easier to predict what's going to happen over the next 10 years in the market than predict the next 4 quarters, because the stocks go up and down in the long run really for 2 reasons: earnings growth and price to earnings compression or expansion. So the price to earnings is still very high, and they will compress to average and below average levels, and that will subtract from and so the earnings compression basically works against the earnings growth, and that's why the markets are range bound. So the way you invest in range bound markets, there are basically 4 things. Number one, the buy and hold is basically, it's not dead, but it's in a coma. That's number one. Number two, so what you want to do, you want to be a buy and sell investor. You buy stocks when they're undervalued, and when they become fairly valued, you sell them. You don't hold them. Number two, you increase the margin of safety you require when you buy stocks. So instead of buying $1 for 80 cents, you start looking for 50 for 50 cents, $1, and this makes your stock selection more rigorous. Number three, in the absence of good stocks to buy, you hold cash. So in other words, if you don't find enough good stocks to buy, you have the residual of your portfolio in cash. And number four, over the last 100 years, actually during the last range bound markets, 90% of the return came from dividends. So what you want to do, you want to make sure that in your stock picking, you favor a higher dividend yield in stocks. Now
that makes a lot of sense, yeah. But as far as holding cash, what are you telling me to do? Hold cash over a 10-year period? How much?
No, I'm not telling you this. What I'm saying is this: this is really a stock picker's market, but I would argue that cash is better than a mediocre stock. So instead of you being forced to buy stocks for the sake of being fully invested, opportunity cost of cash is a lot lower in this environment. Therefore, I would rather hold cash unless I can find good stocks to buy. And you can find good stocks to buy right now, but the opportunities are limited.
And I like that advice about the dividend payers, because that's going to give you regular income. Let me ask you, Larry, if you're looking over the next year, I know 10 years, a lot can happen, and you're not necessarily going to make predictions over a 10-year period, but where do you want to invest, let's say, in the coming year?
Well, again, we remain very agile in terms of asset allocation. At the moment, we think we're still in this environment where most risky assets will do well, whether it's corporate bonds, whether it's stocks, whether it's emerging markets. Again, this combination I was talking about before is very bullish for financial assets. Once we see some of those props give way, that is zero rates, for example, or corporations stopping saving and starting to spend and borrow, then we're going to maybe recommend to get out of stocks for a while and look at some other kinds of asset classes. So, again, right now, we like stocks, we like corporate bonds, we like emerging markets.
All right, we will leave it there. That certainly has been what's working now, that's for sure, and it's been a while. Vitaliy, Larry, thanks very much. We appreciate your time tonight.
My pleasure.
We'll see you soon, gentlemen. Thank you very much.